Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. What I'm going to do in today's video, I've been asked by subscribers to compare three very powerful, very prominent growth stocks: Advanced Micro Devices, NVIDIA, and Broadcom. Now, these companies are all competitors in many ways, and they all have their own unique characteristics. So what I'm going to do today, I'm not going to get into what each of the companies do. I'm going to let you basically do that if you're so inclined after watching the video and want to research any of these stocks further. And I obviously highly recommend that. I'm just going to take a by the numbers look here and look at the value these companies have, what their stock prices have performed like based on the growth of those earnings. And then we'll compare each of them to see which might be the best value going forward. All three of them are great companies. All three of them have some very powerful characteristics. But the question is, are all three of them great investments? And let's go through the exercise together and see what we come up with. All right, the first stock we're going to look at is NVIDIA, which is really the 800-pound gorilla in AI, if you will. It's the most prominent AI stock. And I wanted to show this chart in this way. I'm going to be using adjusted operating earnings here. Now, the stock doesn't pay a dividend, and so it's really not about income. So I'm not going to look at cash flows. I'm just going to look at earnings and the relationship to stock price and earnings. Now, one of the attributes of fast graphs are that when you get very fast growth stocks, growth exceeding 15% a year, and as you can see over this maximum time frame going back all the way to the beginning of fiscal year 2006, AVGO has grown earnings by 36.76%. Now, one of the things we utilize for growth stocks is Peter Lynch's famed formula, P equals growth rate. Okay, and we're going to basically calculate that growth rate over this time frame. And you can see at the bottom here of the graph, you've got the detail of each individual year. We had some really powerful growth in 06, 07, even 08 was about equal to its current growth. Then we had a negative year. You're really hard to see that on the graph. And then we had 6%, 150. So if I use the scroll bar and scroll back in time and get rid of some of these growth years here, I do want you to see that its growth has been very choppy, but I do want you to note this. The company's earnings drove the stock price. As earnings grew, the stock price grew with a lot of volatility. When earnings collapsed, the stock price collapsed. As earnings started to grow again, the stock price grew. Earnings determine market price and drive market price in the long run. But now I'm going to move this forward a little bit. Then we came into a period in 2010 forward where we had 39% growth. So I want you to know, now I've adjusted the PE as a PE of 39, or PE ratio equal to the company's growth rate, as Peter Lynch taught us. So now if I analyze this during this time frame, there was a period when the company was trading at very low multiples of earnings, but that was also a time when there was some real weakness in the company's earnings growth. Okay, the average from point A to point B is 39%. So let me move it forward some more. Now we got 34%. Now we're using a PE of 34. But for this time frame, it gives us a good perspective as far as how earnings were adjusting. And we can see when earnings got significantly above that, we started to see a correction to the mean. All right, now I'm going to move it forward some more. And now we've got an earnings of 53%, 52.96. Now we're drawing the orange line as a PE of 53. P equals growth rate. And you can see the stock price during this time frame track that at that level very nicely. That's what fast graphs is all about. It's a dynamic tool, and when you change time frames, you get different aspects of different information. It helps you understand better. Now, as I move forward, now going from 2019, we have a growth rate of 49.35. I'm using the P equals growth rate of 49.35. So the orange line is a PE of 49. And historically it's traded at between 48 and 49. So here the normal PE during this time frame is basically the company's earnings growth rate. All right, now if you calculated performance just real quickly and kind of loosely, we end up with a 48% annualized rate of return with virtually no dividend, because earnings and the rate of change of earnings create the value. And this is when the stock looks undervalued at this level of growth at this point in time. Okay, so now I'm going to do some other machination here. If I go 15 years, we get 45 times earnings. And we see this real interesting correlation. Now we get into a period where the average market PE is a little different. But either way, the company looks like it's attractively valued. Now, if we hone in on just the last growth years, I'm still going to eliminate the 2023 year, it was negative. Now we've got an 80% growth rate. So we're using a PE of 80. That's pretty unrealistic valuation. And note that the company didn't really trade at that at all. FastGraphs is telling you that. What it did, in this case, the blue line becomes more relevant over this time frame. Okay, but the critical point is, what about the future? So we go into the forecasting graph, and what we've got here is 58 analysts forecasting growth over the next 2 or 3 years. It drops down to 53 and then down to 22. So the further out you go, the fewer analysts you have. But the consensus of all these analysts together are looking for a 26.49% growth rate. That would indicate a fair value PE of 26.49, meaning the PE would be equal to the growth rate. Now, the normal multiple over this time frame has been that 48 number. So you have to make that decision as an investor whether you think the market's going to continue to apply a 48 multiple, even if the earnings growth rate begins to slow down. But if you look at NVIDIA from a standpoint of forecast growth, it's in the value corridor here. It's fully valued or highly valued. It's not undervalued, but that still could give you a nice attractive rate of return. And of course, if the PE stayed at the current blended PE of 31, which would be right here, then we'd be looking at almost a 27% annualized rate of return. So there is a lot of opportunity. Of course, if it continued to trade at a 48 multiple, like it has over the last 5 years, that's the 5-year normal PE here, then you're looking at something that could make you 45 or 46%. But I want you to focus on risk here. When you're dealing with this kind of growth and these kind of valuations, you're dealing with a real high risk assessment. Okay? But anyway, that's the NVIDIA. Now, there's a lot of arguments that NVIDIA could be bought today at a reasonable valuation based on what the company's growth numbers have been really more recently, but most importantly, going forward. You can learn from the past as we did by analyzing NVIDIA, but you can only invest in the future. So the next one, we're going to look at advanced micro devices. Now, over the long run here, which goes all the way back to 2005, we see that earnings growth has been around 14%. Now, here we're using a different formula because it's less than 15% growth. So we're using a 15 multiple as the fair value. But again, watch what happens when I take time off of the graph. If I'm looking from 2013, the company grew at 30%, and that gives it a 30 multiple PE equals growth rate using Peter Lynch's formula. Okay, but you also need to know what that growth rate is made up of. We got 30% growth, 155 minus 1,000%. And again, you can use your scroll bar and go back in here and you can see these periods where growth was sketchy. And you can also then see where growth has been more consistent. And again, take more time off of this graph. And now all of a sudden we got a 44% growth rate. So once again, we're looking at a PE of 44. The stock looks very attractive there if you're willing to give it that. But by glancing at the graph, I have these numbers that are skewing the results, these big numbers. If I'm looking going forward, I'm seeing numbers of 25, 39, 33, and 29. So when I go into forecasting, I'm getting a consensus of analysts, and again, pretty widely followed. By the way, the company has an A credit rating. It's got long-term debt to capital of less than 4%, which is very attractive from a debt point. In other words, it's got a healthy balance sheet, in my opinion. The company's expected to grow at almost 33% a year. So once again, using the P equals growth rate formula on the estimate tab here, advanced micro devices would be inexpensive. You could stand to make 50% annualized rate of returns. Now, you've got this calculator function here. If the PE was only 16, or it grew, you could still make 15%. So you could see a lot of PE contraction and still make money on this stock. Now, the normal multiple for the company over the last 5 years has been over 53. This would make it an absolutely screaming home run. Okay, but that again, is that really a realistic number when we're seeing growth of only 32%? I personally think not. I like to focus on a PE, and for high growth stocks now I'm talking, that is basically in line with the company's potential growth. But having said that, I believe AMD is very attractively valued here based on the fundamental strength of the company and what the analysts expect. And by the way, another feature, and I can do this for all three companies, I'll go back to NVIDIA. Analysts, this is something important, analysts have been lowering their earnings forecast for the company over the last 6 months, 3 months, and previous, okay, and lowered it quite a bit. If you look at the scorecard for AMD, am I on AMD? Yes, look at the scorecard for AMD. They have missed estimates about 35 or 36% of the time, but they've also had a lot of success with their estimates. So I say we can look at these estimate potentials here, hopefully with a pretty high degree of confidence. So let's go back to NVIDIA and look at the same thing. NVIDIA's earnings estimates have been right on the money. And so when we're forecasting at 26%, we would have a very high level of confidence that NVIDIA might be right. And the difference is with NVIDIA, notice that the earnings estimates have been increasing since the last 6 months, not decreasing like they have with Advanced Micro Devices. And then finally, let's look at Broadcom from a valuation perspective. When I look at this graph, and again, this is the max graph that we can draw in fast graphs, I'm getting a picture of a 30% grower. So this would be the P equals growth rate, 31 PE multiple. But note that stock really never traded at that multiple. I call this, for whatever reason, a blue line company, except for the last couple of years. In other words, the average normal PE ratio has been about that 15, that magical 15 number, 15.5 in this case. And then it got pretty highly valued, but now it's come back into value. But now if I shorten the time frame, see the growth rate has fallen. Here I'm using a 19 multiple, 18.9 as the fair value multiple, because that's the kind of growth. If I shorten the time frame since 2022, and this has the October fiscal year, I've had over 20% growth. So I'm using a PE equal to growth of 21.64, but yet the normal PE has been almost on the money at 21.56. But let's look at growth going forward. Growth going forward is expected to grow at about 20%, so that would be a PE of 20 on this chart, and that would make it look overvalued. If I calculated the number, I'd have a very low possible rate of return. If I went to the normal multiple, which is down here at 17, I could actually lose money owning Broadcom. So historically, the company has clearly traded at a discount even to its growth rate when it was strong. It's been a blue line company, as I call it, somewhere in the 15, 16 multiple. So I don't find it strange that the market, when they put a normal multiple on of around 17, even though we're expecting 20% growth, that's kind of normal for this company. Now, I'd be taking that into consideration as I was analyzing whether Broadcom is a good investment or not. So looking at all three from a numbers point of view, I would say Advanced Micro Devices looks like the most attractive based on strong growth. But keep in mind, when you're talking about 33%-ish growth here, it's a lot harder to achieve that than it would be for Broadcom to achieve 20% growth. And when you get into NVIDIA, we're looking at 26% growth, and that is possibly achievable for this company. So NVIDIA, I would say, is reasonably valued based on pure numbers. I would say AMD might look attractively undervalued based on purely on numbers. And looking at Broadcom, or AVGO, as the symbol AVGO, it looks like it's overvalued based on how the market normally has valued the stock. But all three are good companies. But what I hope you got out of this was you learned from the past, you only invest in the future, and you got to really pay attention. Don't get caught up in what the market has valued it at, because you need to understand why. It's valued, for example, NVIDIA at these high multiples here because the company grew earnings at high multiples. If the earnings growth going forward is going to be lower, then there's a very strong probability the market over the next couple of years will be valuing the stock lower. And that applies to every one of these companies. Advanced Micro is considered the opportunity to grow the fastest, but keep in mind, analysts have been lowering, and it does have maybe the weakest analyst scorecard of the group. AVGO has almost, or Broadcom has almost a perfect scorecard, which means you can have a lot of confidence that the analysts may be correct. NVIDIA has had a very strong scorecard. They only missed 9% of the time in the 1-year forecast with a 10% margin. But if you look at advanced micro devices, analysts have gotten this wrong over 30% several times. So it's all a matter about weighing the risk and the rate of return. This company is expected to grow the fastest, but can it? And based on the analyst estimates, are the analysts going to continue to lower these forecasts, or are they going to be the same? The only way to know that is to continue to do your research. FastGraphs offers external links. You can go into the company's website and get information on each of these companies. You can go into other sources like Morningstar, which I basically subscribe to. You have to subscribe to some of these and look at what Morningstar says about the company. I'm not logged in, but you can also go to Zacks, which is another one. You can go to Seeking Alpha, which is another one, and basically see what the people at Seeking Alpha are saying about the company. But what you really need to do is do your own research and research these companies thoroughly. But pay attention to risk, reward, and the reality of how fast a company can grow. Big numbers are hard to achieve for stocks. And the bigger the company is, the harder for it is to achieve big numbers. I might want to say that. They call it the lull of large numbers. So as these companies get bigger and bigger, looking at NVIDIA with a $2.5 trillion market cap, $3 trillion total enterprise value, versus Advanced Micro with $140 billion market cap and almost $149 billion total enterprise value because they have such low debt. And then, of course, you look at Broadcom, which has much more debt. They're at $820 billion market cap, but over $907 billion enterprise value because they do have the most debt. And all these things need to be weighed into your process. These are all growth stocks. They're all good companies, and they could fit your portfolio. And watch for valuation. Look how much valuation has changed, for example, on Broadcom just in the last several months. And you can see it even more dramatically by looking at the historical chart. We had high value and low value. Same can be said for Advanced Micro. Looking at the historical chart, we've had a big change in valuation over just the last several months. And then the same with NVIDIA, looking at the historical chart. We've seen NVIDIA's earnings drop dramatically. And remember, when I use lower growth rates, then the valuations look different because I'm valuing it at a different level. And this is an analytical tool to think with. You want to look at what you're seeing, evaluate where the numbers are coming from, how they're being created, and then use that information to help you make an informed, intelligent, and hopefully profitable long-term investment decision. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. This is actually a subscriber request where they wanted me to compare these three. I did find the exercise interesting, and there are a lot of lessons in valuation in this particular video. So I hope you enjoyed it. I hope you learned something. If you did, ring a bell, give me a like. Take a look at subscribing to FastGraphs and subscribe to our YouTube channel. Thanks for watching.